السلام عليكم ورحمة الله وبركاته. Welcome everyone. السلام عليكم ورحمة الله وبركاته. Welcome everyone. This is Ibrahim Al-Khifam from the Financial Academy. Today we have one of the webinars that talk about the risk, fintech regulations and risk and challenges. But first of all, we'd like to talk about the Financial Academy. The Financial Academy is one of the initiatives that support the financial sector development programs, is one of the main programs that support the vision of 2030 of the Kingdom of Saudi Arabia. Today we have one of the speakers who has a quite good long experience in the financial sector and in working with has worked with organizations, global organizations and governments. Dr. Jane Thompson. Welcome, Dr. Jane.
Thank you.
We would like to start this journey and give a small brief about yourself and start with this webinar. Thank you so much.
Thank you very much, and welcome everyone. Good afternoon, and I'm really looking forward to bringing you this seminar on fintech regulations, risks and challenges. Just a brief introduction to me. I've been an entrepreneur and a researcher and an academic, and in particular, since 2016, I moved into technology and particularly fintech and blockchain and digital assets. And I've spent the time since then really trying to understand what's happening with them and discuss and pose questions about how this is going to impact on the future. I am the non-executive director of an ASX listed bank. I'm also the chair of Casso Holdings, which is the first digital asset security listed on the Aquis Exchange in London. I'm on the editorial board of 3 peer-reviewed journals, and I'm an industry associate of the University of College London Centre for Blockchain. I've written 3 books around digital change and applied world and advancement in the world of web. A look at the future. I'm hoping to share with my thoughts, experiences, regulators, and some of the with the survey to around 4. We will then have a break, a comfort break, and come back after 5 to 10 minutes for another presentation, and then we will stop for questions at the end. So welcome everyone. So what I'm going to be trying to do in this presentation is first of all talk to you about some of the global trends in fintech, because this is impacting on what's happening in Saudi Arabia, in the region and in the world in general. Secondly, talk about some of the risks and challenges of fintech. Thirdly, talk about the issues related to compliance, regulation in fintech, and then discuss the key ethical and risk considerations of using fintech in a financial services organisation. And I hope at the end of this, you have a big picture understanding of what's happening in fintech, where it's going, and how it might be relevant for you and your organisation, and how, as a financial services organisation, you need to be thinking about some of these developments in the future. So the first section of my presentation is going to be around understanding global trends in fintech. And there are some trends which are really not fintech specific, but they're very important that you understand what's going on, because this is affecting our world in profound ways. The first one is datafication, or the digitization of everything. So people say, and you might have heard the expression that data is the new gold, or data is the new oil. Data is going to be the most valuable commodity in the world, and everything is being digitized. and people are connecting these interconnected networks of value exchange, which will impact on how financial services operations work. The second one is something called dematerialization. And this is a trend towards a reduction in the material used in products, as people don't necessarily want to own things anymore. If you think of an example, you think of Uber and Airbnb, where people happily share their cars and share their houses with others, so creating this sharing economy. And I'll talk in a moment about the new generations coming up. They don't have the same attitude towards ownership of goods that people of my generation and the generations that have come after me have had. So we're moving into very much more a service economy rather than a goods economy. The third trend that's very important and very important for financial services organizations, as we will discuss, is what we call platformization. So people are making huge platforms that consumers connect to. Consumers themselves can be producers on the platform, and the platforms scale by investing in their networks. So the more significant their network, the greater their value. But what this will also mean for financial services, and we'll talk about this, is that non-financial services firms are now moving through these platforms into the provision of financial services. And in the same way, we expect to see banks, traditional financial service organizations, moving into the provision of other adjacent services that they might not have thought was the job of a bank before. And then the final trend is really the concern that we're seeing around ESG, environment, social and governance, or you will have heard about the Sustainable Development Goals, where people are interested not just in tracking profits, but are interested in tracking social and resource value and accounting for these different forms of value, like green bonds, social impact bonds, company loyalty schemes, carbon accounting. And Web3, which we'll speak about, will be the infrastructure that allows us to track those social and environmental values between companies and people. So these are trends that are impacting on every country, everywhere. So first of all, data, everything is being digitized. Your personal data, your behavioral data, your financial data, everything is being digitized. And people have tremendous amount of information about consumers that they never had before, and that data has value. Secondly, people are less concerned and will be less concerned about owning things than they did before, and will be concerned about getting access to the services or the things that they want. Everything's going to be built around big networks and big platforms. So thinking about how that will impact on your organization is important. And then finally, a greater awareness of environmental and social concerns than we've seen in previous generations. And it's important to think about Gen Z or Gen Z and Gen Alpha, because Gen Z are now making up over 30% of the workforce, and Gen Alpha are the next generation coming along. And their expectations are very different. The way they think about things and the way they do things are very different, and this will impact on financial services. So Gen Alpha will be the most technologically advanced generation ever. They will not have known life without artificial intelligence, augmented reality and gaming, and this will impact on their approach to learning, to work, how they socialize, how they spend money. So everything about every company's future has to be thinking about these customers of the new generation who will want very different kinds of relationship with their financial services institutions. So companies need now to explore the best ways to combine the virtual and physical worlds of their products and services for Gen Alpha. So thinking about this new generation, Gen Z and Gen Alpha, has to be part of every financial services organisation strategy. Now, moving on to trends in fintech, Forbes has suggested that fintech will reach 174 billion this year. We're also seeing increased adoption of digital assets globally as the global market in digital assets approaches trillions of dollars. One of the other trends that we're seeing is that emerging markets are dominating the global digital assets adoption. So if you look at the top 20 countries where proportions of the population own digital assets, most of them are from emerging economies. And it's estimated that there's 420 million crypto users around the world as of 2023. And it's not just the people who are moving into the digital assets of the new generation. Traditional hedge funds are looking at the market in the longer term and are increasing their digital asset holdings and maintaining, if not increasing, the amount of capital deployed in the ecosystem. But one of the challenges that they have is regulatory uncertainty. So that's one of the reasons we need to talk about regulation today. And barriers increasingly weigh on investment decisions of many funds, and they would be more likely to invest more in digital assets once they have greater transparency, regulatory certainty, and risk management. So one of the things holding back, particularly the digital asset space, is that regulatory uncertainty. Oh, sorry, I've just gone in the wrong direction. So let's just talk about some of the technologies that are relevant to fintech. So AI and machine learning, and we've all heard a lot about AI and machine learning as we've seen ChatGPT literally explode into our worlds. So it is going to be able to revolutionize banking, payments, investments, and risk management. And fintechs are leveraging the AI and the machine learning to automate processes like loan origination or fraud protection, providing more accurate insights into customer behavior. And businesses are looking at reducing the costs of manual labor while increasing overall performance and accuracy and efficiency. The second important fintech trend is around embedded finance. So these are products that are used within a platform. And I spoke just previously about the growth of these platforms and networks. So users can better manage their finances without switching between several apps or websites when these services are embedded inside an existing app or platform. And this is a challenge for banks because other types of services are providing financial services applications from their own platforms. So buy now and pay later is one of the fastest growing embedded finance models, where customers can make their purchases first and split out their payments over time using this service. And it's estimated that the market for embedded financial services will expand by 40% annually over the next several years. So just a little bit more detail on embedded finance. So first of all, we have embedded banking. An example of that is the ride-sharing app Lyft, which offers a checking account and associated debit card exclusively to its drivers. So drivers can get paid immediately after every ride. Shopify Balance is another example where store owners can skip the bank by getting paid faster and eliminating the need to open a separate business bank account. And Shopify is also offering a debit card with exclusive rewards for purchases made towards growing a Shopify business. So people are highly incentivized to use these services. The second type is embedded payments, which make the process easier by connecting and saving a payment method to use later with just the click of a button. So Starbucks, for example, saves credit or debit card information for one-click payments while customers earn points for using the app. So this is highly convenient for customers who are buying 1, 2, 3 cups of coffee every day. Another example is branded card payments, payment cards. And I'm sure you've all seen one of these, even if you don't have one. So this is where Fintech has expanded companies' ability to offer branded credit cards. So you can have a credit card from your favorite department store or your place you buy gasoline, for example, or even some of the luxury brands are now offering branded credit cards. The hotel luxury chains are offering branded credit cards. The airlines are offering branded credit cards. Number 4 is embedded lending. So this is the buy now, pay later, which is very common, as I mentioned before, and companies are easily offering more payment offers to their customers. And finally, embedded insurance. And this allows users to purchase insurance online at the point of sale. So it's offered when and where people need it, and you don't have to have a separate engagement with an insurance company or agent. So you purchase your computer and you buy your computer's insurance at the point of purchase from that store that you bought your computer from. So these are some of the main categories of embedded finance. Going on to other global trends in fintech, software as a service. So you can access and pay for software applications hosted in the cloud without installing them on their servers or computers. And SaaS provides access to powerful tools for organizations with enhanced security protocols for data storage and management that would be difficult or expensive for many standalone individual firms to implement for themselves. And then finally, open banking. So open banking allows customers to securely share their financial information with third parties, offering them more control and flexibility over their finances. So this opens up possibilities for banks, payment companies, and other fintech firms looking to leverage the potential of customer data. So customers have greater control over where they store their financial data, and they can quickly transfer it between organizations or allow third-party providers to access their data when necessary. And this provides customers with transparency, choice, and control. The next trend in fintech that I'd like to mention to you is IoT, or the Internet of Things. So this enables physical devices connected to the internet to collect data, analyze it, and act on it without human intervention. So banks can use sensors embedded in their products to monitor customer activities and automate responses based on preset preferences or behaviors, such as fraud detection algorithms or automatic payments triggered by changes in customer spending patterns, for example. Voice recognition technology is also being used for authentication purposes, simplifying login processes and improving security by making accounts more difficult to hack. The growth in digital assets, which are underpinned by blockchain, is another phenomenon that I briefly spoke to you about. So this is a decentralized digital ledger that records and verifies different types of transactions, and it allows the peer-to-peer transfer of digital assets without a third-party intermediary, and can be used for various financial applications, including payments, transfers, and trading. Blockchain and digital assets have implications for cost savings due to its distributed nature. For example, reducing the need for intermediaries like banks or brokers can reduce costs associated with international financial transactions. It allows for increased transparency, which means anyone can go on the ledger at any time and see exactly the state of the ledger. So it improves trust in financial systems by reducing fraud and delays in settlement times. Institutional investors are coming into the market in a big way, driven by the growing recognition of the potential for digital assets, particularly to serve as a store of value and as a means of payment. And financial services and adjacent industries are starting to adopt blockchain and tokenization, which I'll speak a little more about in a moment, as their basic transaction infrastructure. And we're also seeing the re-emergence of permission blockchains, which can offer greater control over the network and its participants, as well as improve scalability and faster transaction times, meeting the burden of regulatory requirements. So this is particularly relevant for banks. For a period of time, there was a lot of interest in public blockchains, but a number of banks and financial services organizations are re-looking at permissioned or federated blockchains. So some of the trends that we're seeing in the region is, first of all, the Middle East and North Africa is the fastest growing region in the world for the ownership of digital assets. The main purposes that digital assets are being used for in the region is for savings preservation and remittance payments. And the number of fintech hubs in the GCC has risen from 1 in 2018 to 4 in 2022. And the Fintech Saudi is the Fintech hub here in Saudi Arabia for Saudi Arabia. And the level of fintech investment has reached 448 million in 2021, with over 108 transactions involving fintech. So it's growing. So as I said, cross-border payments has some of the largest remittance corridors in the world, connecting with markets such as India, Pakistan, Bangladesh, Sri Lanka, and Philippines. So we're seeing digital assets being used as a form of remittances because it's immediate, it's peer-to-peer, and you can send your remittance directly to the wallet of the person that you want to receive the money. So UAE and Saudi Arabia handled 78 billion in payments in 2020 through digital assets, as millions of unbanked and underbanked people reside in the region. Open banking is also a key enabler for the growth of fintech in the MENA ecosystem, and this creates an opportunity for either traditional financial institutions or fintechs to build applications ranging from payments to lending on top of its API infrastructure. And Saudi, Egypt, and UAE are all in the process of developing their own open banking regulations. Some of the trends my research has shown in Saudi is it's the third largest crypto market in all of MENA. Saudi has a very strong national fintech strategy, aiming to position the country as one of the top global fintech hubs, with 500 active fintechs by 2030. We already have 30 payment fintechs operating in Saudi. And the point of sale transactions in Saudi Arabia doubled between 2018 and 2022 and is likely to double again by 2026 to reach almost 1 trillion Saudi reals. And the number of point of sale devices in Saudi Arabia is expected to triple to 1.5 million by 2025. The e-commerce penetration rate by users has increased 60.6% in 2021 and is expected to reach 70.9% in 2024. And embedded finance is becoming particularly popular. So the growth and the population of fintechs in Saudi Arabia is very impressive, and the favourable strategies and policy directions of the government are encouraging this kind of growth. So just in terms of the forms of fintech in the region, payments has absolutely been the dominant fintech investment, followed by crypto and DeFi and mortgages and lending. You can see from the graph there just how much payments dominate fintech investments in the region. Now, continuing to talk about some of the fintech innovations that are important for financial services organizations to be aware of is this movement towards tokenization. And many will say the tokenization of everything. So tokenization has the number of benefits. First of all, it can democratize or make more accessible fractional ownership, enabling even small retail investors to diversify their portfolios and access formerly exclusive markets only accessible to large-scale investors. And so investors can invest in small percentages of tokenized assets, like real estate, for example, or gold, and it removes the barriers for billions of investors to enter the market. So it makes it more accessible to small investors. Tokenization can also unlock the value of illiquid assets, realizing their liquid potential and becoming tradable on secondary markets via fractional ownership. So again, I mentioned real estate and gold. These are two of the most popular assets that are being tokenized. Tokenization enables faster transaction and settlement with quicker transactions through automation and blockchain smart contracts. Tokenization can improve traceability and transparency, as through this immutable shared ledger, it keeps track of all actions on the ledger on a given asset, and all parties have visibility. So it's completely transparent. It also can improve the interoperability of tokenized assets and eliminate the physical barriers and geographical infrastructure constraints, and it removes the need for middlemen or intermediaries to be involved in the transaction. So it's a very substantial transformation for financial services as tokenization gets increasingly popular. Accenture estimate, I've just gone ahead, to estimate that at the current utilized chains enable investors to save billion of US billion, a 20% cost saving. So particularly looking at process and efficiency. So that's of the just talking about what are these innovations that are coming down the track in fintech that are going to impact on financial services organisations, and that financial services organisations should responsibly be thinking about and preparing for. So the next section of the presentation is going to talk about the risk considerations of using fintech in a financial services organisation. In this table here, if you look down the left-hand column, it's talking about some of the categories of risks that financial services organisations need to be thinking about. So the first one is around legal certainty. And as I mentioned earlier, this idea about legal and regulatory certainty is holding fintech markets back. Fintechs will thrive and survive in countries that have very clear and well-regulated markets. Secondly, around effective risk monitoring of fintech operations, because at the moment we don't have common taxonomies. We're limited with the data that's available on the activities of fintechs, and so governments and financial service organisations are not confident necessarily that they really know what's going on and that they can monitor the activities of fintechs. A third concern, particularly of central banks, is around financial stability because of the interlinkage with the wider financial system, issues of currency substitution, and digital asset service providers generating systemic risks and third-party risks and market risks. So many are very concerned about preserving financial stability, and this is an issue that regulators are looking at very seriously. The fourth category of risk, of course, is consumers. Consumers are vulnerable to these new fintechs that are coming through, both through being offered, for example, too much lending putting all their assets, borrowing to put their assets into digital assets, and so they end up, in financial ruin. The operational failures that are possible with any new technology, cyber attacks, lack of recourse to compensation, and I'll talk to you in a little while about automated organizations that are governed by code where there is no recourse to anyone if something goes wrong in that organization. And this is a big issue for regulators. Market integrity is another matter, because in an unregulated market, you have risks of market integrity. And then cross-border cooperation, because at the moment we're in a situation where there's no globally accepted standards, no globally accepted taxonomy around fintech, no globally accepted rules around the movement of money or digital assets from one jurisdiction to another. So there's a lot of issues that are currently on the regulator's plate, thinking about how to address cross-border collaboration in terms of fintechs. If you have a look at the right-hand column here, and I hope the Financial Academy might share this slide with you because it's quite detailed, and it might be something that's very useful to you to go through at your leisure to understand. And if you look at the right-hand column, it looks at what are some of the things that governments and regulators and financial service institutions might think about in terms of each of these issues. So, for example, on So welcome back. I apologise for the short break in proceedings while we got the Wi-Fi working again. And I'll just continue to talking about financial stability and some of the steps that government, regulators and policymakers can take around prudential requirements on bank exposures and monitoring of indirect exposures, restrictions on regulated entities engaging with certain risky digital assets, cross-border cooperation and targeted restrictions, prudential requirements commensurate with risk, and extension of regulatory coverage to entities with critical functions, and the wind-down arrangements and resolution and guidance from principles for financial market infrastructure for designated entities. So on consumer protection, some of the issues that regulators and policymakers and organisations need to think about are segregation and safekeeping of consumer funds and appropriate record keeping, clear complaints procedures, user education, and limits or restrictions on the use of leverage, and accurate and clear marketing. In relation to governance requirements and market integrity, looking at the issuance of white papers for digital asset service providers and what they plan to do and how they do it in terms of the technology, limiting the products that can be offered by crypto asset exchanges, minimum reporting requirements on crypto asset service providers. And then on cross-border cooperation, cross-sectoral global standards to close policy gaps, and implementation of existing global standards in domestic regulation where possible, and close cooperation between authorities that host crypto asset service providers and jurisdictions where those services are marketed. Because often these service providers are virtual and they're not necessarily registered in the jurisdiction where they're selling their products. So staying on the topic around risks, looking at interoperability with legacy systems, because many organisations have challenges around transitioning to digital systems, and these new solutions need to be able to tightly integrate or interoperate with existing systems. The second is the dynamic regulatory environment, which we've spoken about, because there are no existing global regulations or standards, and everyone's struggling with the same issues about what to regulate and how to regulate without stifling the innovation in the market. Standards and governance need to be developed, and many banks and financial services organisations simply don't have the in-house support or talent to be able to work on these issues. And so securing that kind of knowledgeable technical support is quite difficult for organisations wanting to work in these markets. And then the speed of the network is predicated on the consensus protocol and the number of nodes in the blockchain. So as I mentioned before, many banks and financial services organisations are promoting speed and security by using these permissioned blockchains. And then finally, the integrity of the data. Blockchain can only validate the accuracy of the record on the network, not the accuracy of the data that goes onto the network. Therefore, it's incumbent on the borrower to record and report borrowing, which can be made publicly available to be traced. Decentralized finance really became very popular in 2020 and 2021. And this poses a lot of issues for traditional regulation, as much of the regulation in the legacy world is focused around regulating intermediaries. And unlike traditional financial markets, decentralized finance doesn't close. They operate on a 24-hour, 7-day-a-week basis. So regulators are struggling to think about how activities across borders can be regulated on a 24-hour, 7-day-a-week basis. And for consumer protection, anti-money laundering supervision, regulators need to look at how they can use alternative mechanisms to control these decentralized finance markets. So we need a whole set of new definitions. We need thinking about developer liability, what's the legal status of code, the application of AML and KYC, and jurisdiction governance mechanisms for change are required. Because remember, if you've got an automated code-governed organisation, it keeps going because it's driven by the smart contracts and the code. So how do you stop consumers and investors getting hurt when activities are not controlled, moderated, or intermediated, hosted, or validated other than a smart contract, which is a piece of code? So I want to talk just for a moment about AI, artificial intelligence, because artificial intelligence can be used for positive or harmful purposes. So, for example, generating deep fakes, which can influence democratic processes and cause deceit, creating misinformation and disinformation, encouraging people to self-harm, and inaccuracies from AI models can also create many problems, including unwanted bias and misleading or erroneous outputs from generative AI. So the Institute of Business Ethics identifies some of the risks related to AI as, first of all, ethics risk. So certain applications in the AI systems adopted might lead to ethical lapses. Second is workforce risk. Automated jobs can lead to a de-skilled labour force and job losses. Third, technology risk with black box algorithms can make it difficult to identify tampering and cyber attacks. Fourth, legal risk with data privacy issues, including compliance with GDPR. And then algorithmic risk, where biased algorithms can lead to discriminatory impact. So as you can see, right across fintech, digital assets, AI, there are a plethora of risks that banks and financial services organisations need to deal with and be thinking about, but in an environment where we don't have a global stable regulatory regime or framework or even standardised terms and definitions. So that brings us to the end of the second part of the lecture. And although I know we lost a few minutes with the internet interruption, let me give you 5 minutes to take a short break, to go to the bathroom, to get a drink, and we'll resume again in 5 minutes' time. So we'll be resuming at, say, 2:30, and I'll start again. So thank you very much, everyone. Enjoy your break. Good afternoon, everyone, and welcome back to the Fintech Regulation Risks and Challenges seminar. Thank you for coming back. We're now going to talk about some of the issues related to compliance and regulation of fintechs. So many countries, as I said, have really struggled to implement regulatory frameworks that provide industry with legal clarity, which protects consumers and investors and prevents bad actors from participating. So there are a number of key issues that we're going to talk about. One is around the Financial Action Task Force, which has made recommendations related to money laundering and counter-terrorist financing. The second is the regulation of virtual assets and digital assets is not consistent across regions and some of the problems that entails. And then also issues related to the debanking of fintechs and other enterprises. So these are all some of the regulatory framework issues that people are dealing with. So if we look around the scope of regulation, what we're seeing is both voluntary mechanisms to try and encourage a particular set of behaviours and actions, such as principle guidelines and voluntary standards, or formal regulatory mechanisms that impose formal legal obligations and changes to the law. So many countries are using a combination with a broad set of general regulations, mainly technology neutral, for example, consumer protection, online safety, privacy, and criminal risks. Second, sector specific. So this is therapeutic goods, financial services, food safety, motor safety, and voluntary or self-regulation initiatives like ethical principles for AI in this case that provide guidances to businesses to responsibly design and implement AI. So in relation to AI, for example, the EU Digital Services Act came into effect in November 2022 and will be wholly applicable in February 2024. And this applies to all digital services that connect customers to goods and services or content. So it creates obligations for online platforms to reduce harms and counter risks online, including how they design services and procedures. And it also introduces protection for users' rights online and places a framework, providing requirements for regulators and researchers to access data, including algorithms, and publish transparency reports on content moderation decisions and algorithms used for recommendations. In relation to AI again, in the USA, the White House Office of Science and Technology policy released the blueprint for an AI Bill of Rights in June 2022. And this is a non-binding blueprint that sets out 5 principles and associated practices to guide the design, use, and deployment of automated systems to protect the rights of the American public. And these principles are supported by a technical companion that provide guidance on how to put the principles into practice. The UK has a national AI strategy, which sets out the UK's long-term actions regarding the governance of AI, in addition to broader economic actions relating to the AI industry. And this proposes introduction of cross-sector AI-specific principles to enable more consistency across various sector-specific regulatory regimes. And it's also got an algorithmic transparency standard, which helps public sector bodies provide clear information about the algorithmic tools they use and why they're using them. On the subject of digital assets, so moving from AI to digital assets, the issues related to regulation include, as I have said, lack of consistency as countries adopting independent approaches to tackle crypto, which could stifle innovation. Secondly, decentralized autonomous organizations, which I mentioned to you are these code-based and governed decentralized networks which are formed on pre-existing, pre-coded rules, making it difficult to understand and regulate. And there is no central governance of these decentralized code-governed organizations. Thirdly, operational risks, where poorly designed systems and controls can cause downtime during periods of high transaction activity, leading to large losses of consumer funds. Financial crime, although public blockchains are transparent and allow customer identification, there's an ever-listing growing list of obfuscation mechanisms that seek to protect the anonymity of crypto asset owners. So although they're public and transparent, people are creating ways to try to cover their identities. Consumer protection is a concern, with a lack of understanding amongst consumers, along with minimal regulations, making this a more unprotected space in comparison with other financial assets. And then finally, investor protection. So you've got pricing variations of the same asset on different exchanges, limiting arbitrage opportunities, and leading to parties actively trading on multiple exchanges. So do we have any global regulators or international standard setters? So we have, first of all, the Financial Action Task Force, which is essentially the global money laundering and terrorist financing watchdog. Secondly, we have IOSCO, which is the security standard setter, investor protection and fraud body. And then thirdly, the Financial Stability Board, which is there to ensure global stability of the financial system. So across these agencies, we need harmonisation and consolidation of regulatory requirements, a common taxonomy that governments across the world accept and adopt, and a need for a collaboration between standard setters, both globally, regionally, and nationally. So what have some of the responses of the regulators been to digital assets? And it's quite varied, from embracing it to banning it altogether. So we have quite a range of different regimes and quite a range of different responses. So the European Central Bank has a proposal for a regulation to extend traceability requirements to transfers of crypto assets, known as the European Union MiCA bill. And the Europeans are very proactive and future forward in terms of thinking through the regulation of fintechs and digital assets. The European Union lawmakers also passed the Markets in Crypto Assets Regulation Bill, aimed at regulating the digital asset market. In the UK, the Financial Conduct Authority has oversight to check that crypto asset firms have effective anti-money laundering and terrorist financing procedures, but generally the crypto assets themselves are not regulated. Security tokens, which are tokens with specific characteristics that provide rights and obligations akin to specified investments, like a share, are the only FCA-regulated crypto asset. The UK's Advertising Standards Agency has become involved in crypto asset oversight, regulating the promotion of crypto assets to consumers by increasing its security of social media, web pages, and advertisements. And you may have seen in the news in the last few months a number of high-profile movie stars and influencers who were promoting digital assets have now had court cases taken out against them for false advertising. In China, although China is one of the most advanced digital economies in the world, they banned crypto trading and mining since 2021, ostensibly to support their own central bank digital currency pilot, the digital yuan that you might be aware of. And then in the US, regulation is very fragmented. It differs across state lines and agencies. The SEC, the securities regulator, views many cryptos as securities. The Commodity Futures Trading Commission calls Bitcoin a commodity, while the Treasury calls it a currency. So most likely they're going to have the test to see if it's a security or a commodity. And if it's a security, it needs to be registered with the SEC. And if a commodity, it'll be less regulated. So what you can see from this is that the regulators are taking different points of view. There are global discussions taking place through the global standard setters. And I haven't included it as a slide in the PowerPoint, but the British Commonwealth, which comprises 53 countries, ministers of law have agreed for the development of a common framework for the regulation of digital assets to be prepared and presented to the Commonwealth ministers of law. That is something that is taking place now. And once this is released, and if it's adopted, is probably going to be the largest international regulatory framework for digital assets. So the core components for the regulatory framework need to, first of all, promote the consistency and comprehensiveness of regulatory, supervisory and oversight approaches to digital assets, activities and markets, and strengthen international cooperation, coordination and information sharing. There is definitely a need for international cooperation in the regulation of fintechs of all kinds. Secondly, to create revised high-level recommendations for the regulation, supervision and oversight of a global stablecoin arrangement because of the risks of associated financial stability to address it more effectively. Unfortunately, we don't have a lot of time to specifically talk about things like stablecoins, but I'm very happy to make this presentation available. And if people have specific questions afterwards, I'm also happy for them to be directed towards me. So what are some of the requirements of such a regulatory framework that might be developed? So the first one is it can't be the same as an existing regulatory framework. The regulatory framework has to address the specific features and risks of digital assets. The framework needs to address potential financial stability risks that could arise from the growing interlinkages between digital assets and the traditional financial system. And high regulatory standards need to apply to digital assets like stable coins that could be widely used as a means of payment and or a store of value, as they could pose significant risks to financial stability. So in terms of taxonomy and definitions, there is a real need for an alignment of definitions between and among countries and the regional regulatory and global regulatory organisations. There's a need to develop regulatory technical standards. There's also a need to develop supervisory policies and procedures. Because these digital assets in particular are moving across jurisdictions, information exchange requirements that go with digital assets are very important. And the regulatory and license criteria and guidelines for stable coins, which could pose a threat to financial stability. So all of these things need to be developed and adopted both globally, regionally, and nationally. So countries can't develop digital asset regulations in a complete vacuum because these digital assets are a global operation that operate 24 hours a day, 7 days a week. So international cooperation and collaboration is essential. So one of the key issues around regulation is this principle of same activity, same risk, same regulation. And in general, people are not going to need to regulate the technology. They need to regulate the activity that the technology is going to be used for. So where digital assets and intermediaries perform an equivalent economic function to one performed by instruments and intermediaries of the traditional financial sector, they should be subject to the equivalent regulation. So in relation to a regulatory framework for digital assets, we're looking at licensing. We're also looking at disclosure requirements, prevention of market abuse, environmental sustainability requirements. And I haven't mentioned in the context of this that anything digital, whether it's a digital asset or anything else, is going to create an environmental footprint. And some of the digital assets have particularly onerous consensus mechanisms, which means that they consume even more energy and have been highly criticised for doing so. So environmental and sustainability requirements are also very important. And then the implementation of the FATF travel rule, which is around the movement of digital assets across borders, which identifies the information on the sender and the receiver in digital asset transactions. So these are the elements of the regulatory framework that needs to be developed. So licensing, disclosure, prevention of market abuse, environmental sustainability, and the cross-border movement of assets and the information that needs to flow. Remembering, same activity, same risk, same regulation. So some of the priority issues for regulation in fintech and digital asset space is that collaboration between the securities regulator, competition, data privacy, prudential, and AML regulatory bodies. Everyone needs to be at this table talking about this very, very transformational change that's taking place in the financial services industry. There needs to be an alignment of definitions across this new asset class. There needs to be an alignment of the responsibility and this is working together. Policymakers work together. And the other is this is a very fast-moving technology, a very fast-moving market. So regulators need to keep an eye, keep watching the trends from technology advancements in digital assets and Web3, because new technologies, new ideas, new applications are being developed all of the time and being released to the market. And we just saw how quickly ChatGPT exploded to understand how quickly some of these other technologies will move and will change the space of finance and banking. So those were the considerations that countries are taking into account in relation to thinking about the regulation of digital assets and fintechs. There is no blueprint for this. There is no playbook. The blueprint and the playbook are being written now every day by regulators and by industry and by standard setters who are attempting to understand the value and the benefits of these new fintech and digital asset innovations, but at the same time prevent the harms. I personally always use the analogy around our ancestors when they discovered fire. Fire was incredibly exciting, but it was also terrifying. Fire was going to give them the ability to be able to cook, to be able to be warm, to be able to power steam engines and other machinery. But it also was terrifying because it could burn entire towns to the ground and create tremendous personal injury. And so what our ancestors did was they learned to harness fire. They learned how to use it for the betterment of civilization, and they learned how to control it to prevent it from harm. And this is the way we need to look at these new technologies. This is how we need to look at fintech and digital assets. So in the next section of the discussion, I want to talk with you and think about some of the key ethical considerations of using fintech in financial service organisations. So what we've seen already is that with the innovation, there's opportunities in terms of efficiency, opportunities in terms of transparency, speed of settlement. With AI, for example, we're going to be able to provide more and better services differently to our customers, to understand our customers better. So there's tremendous potential and opportunity in the financial services sector to be able to use this in a very positive way. But there are some serious ethical considerations around using this, and then some thoughts that I want to share with you in terms of, as a financial services organisation, what should you be thinking about in terms of the ethics of some of these innovations in fintech? Because technology is bringing us new choices, but it's only ethics that is going to tell us which of these choices is good. And what we need to be doing as responsible leaders of financial services is trying to choose those choices which give the benefit of the technology and minimize the harm. And this is why ethics is so important in the way we think about our organizations and what our organizations do. And why are digital ethics really not more important than conventional ethics, but they have bigger risk than conventional ethics? Because they're essentially the same questions as you ask in conventional ethics, but the potential for automation of unethical conduct at scale is huge. A biased algorithm can discriminate against thousands or hundreds of thousands of people. So these are the reasons that we need to think about it. Consumer protection is terribly important when you've got the possibility that millions of people could be defrauded by one of these technologies. So it's very important to think about ethics. And it's important to think about ethics at every level. And one of the issues that we should be thinking about as leaders of organizations is that in the past, generally the leaders, the board, the CEO of an organization doesn't know the detail of the tech stack, doesn't know how data is secured, how privacy is protected, how efficiencies are achieved, and how the whole system integrity works. That's often the domain of the chief information officer or the chief technical officer. But in a world where ethical decisions can be automated and can affect millions of people, these are issues that boards and CEOs need to become aware of. And organizations, financial services organizations, need to be considering an ethical information management strategy. What is the impact of the deployment of some of these technologies going to be on your customers, on markets, and, you know, more broadly on the planet? So when the tech stack's being built, there are ethical considerations that need to be thought about. And one of the challenges is that generally computer engineers and coders have no training in ethics. So it's not that they're deliberately not thinking about ethical considerations, but they probably have no way of being prepared to think about it. So this is something that, as a community and as an ecosystem, ethics in financial services, ethics in fintech is something that we should all be paying attention to. With the apps that are being built on the platforms, whether they're digital assets or whether they're embedded finance, we need to be thinking about how to protect consumers, how to prevent money laundering and criminal abuses in relation to digital assets, the volatility, because people can lose all their worldly assets if they've tied them up in digital assets, and some have. How to prevent tax evasion, because again, in terms of the regulations, tax regulation is going to be another aspect that countries and policymakers will need to think about. I mentioned energy consumption of all of your electronic devices and internet, but energy consumption of particular forms of technology that banks may choose to use is a consideration, both for banks and financial institutions, for all of their suppliers and for their consumers. And then smart contract failure in terms of automation is something that people guiding financial institutions need to think about. What do you do when that smart contract fails, but the entire system is automated? So I mentioned briefly about something called decentralized autonomous organizations. And these are the primary organizations that govern decentralized finance. These are not traditional organizations that have a CEO and a board and a centralized authority. They have no centralized authority. They're completely automated. They are governed and operated by smart contracts. So in their design, the people who are putting these together are figuring out what their objectives are and how they're going to operate, and at what point decisions are made, at what point people are rewarded or earn, or how they can borrow and lend and so forth. And this is all automated using smart contracts. There's little or no mechanism for dispute resolution because it's all encoded, and there are a number of high-profile cases where something was going wrong and the community could see it was going wrong, but there was nothing they could do because it was all automated and encoded in the smart contract. It's still in an experimental phase, and not everyone in this decentralized autonomous organization has the same knowledge and information about the operation of the organization. So some people have more knowledge than others. And there's no governance to protect consumers. And who do you call when a problem emerges? At the moment, the regulators have no vision or visibility inside these decentralized autonomous organizations. So this is indeed a question that is vexing many of the regulators about how to get that visibility. And one of the proposals that is being considered at the moment is that regulators, in fact, may operate a node of this decentralized autonomous organization, which means that they can actually see what is going inside that organization. At a societal level, and we know it, technology is changing many, many things. Now, what we do now and what we're going to do in the future. And there will be implications of different innovations being at the moment. So with economic stability, with our consumer protection, one of the other potential of this stage in this platform is teach priorities to be able to their populations, to track people's choice, their habits, and to track their other habits. And, you know, in the case, for example, of China with social credit scoring. The government can be making decisions about people's choices through the ability to be able to look into the data that we have on people, particularly the financial data. Everyone who talks about distributed ledger and blockchain and digital assets says proudly that they're going to displace middlemen. But one of the social consequences, of course, about displacing middlemen is that middlemen are people. They've earned their living from doing this, and they're going to lose their livelihood. So in thinking about who's displaced by any of these technologies, whether it's displacement of middlemen or whether it's in fact replacing workforce with AI, then there's going to be social consequences of this, both in terms of the organisation, but also in terms of government and policymakers thinking about what do these people do. And if I could give you an example, the first blockchain bond was developed through the World Bank and the Commonwealth Bank of Australia. And I interviewed the people who did that bond, and they said in the process of developing and implementing the bond, they actually displaced 11 on settlement and reporting process. So that's a lot of middlemen for one bond. And if you think about all of the other financial instruments and things that banks and financial institutions do, this is going to be a significant issue for a whole sector of the population. And so thinking about the consequences of that has to be something that's taken into account when new technologies are coming in. The consequences of mental health issues on the population of these new technologies, of the fintech benefits that they're being offered that might in fact extend their capacity beyond that which they're able to go, or create in a 24-hour market an obsession with following the market where people don't sleep, for example, because you can't go to sleep if the market's still trading. Issues around equity, human rights, and digital exclusion. If you think about the countries within, say, 4 hours flight of Saudi Arabia, there are many people in those countries that don't have basic digital infrastructure, don't have access to the internet, may only have access to the most simple of mobile phones. So by providing these products to some and not to others, and the people who don't have the basic digital infrastructure, then in fact you could be creating a new class, a new form of digital divide. The impact of data breaches, of personal information, of financial information being mixed with consumer information and health information could be quite catastrophic for some people and for some sectors of the population. And the impact of bias in terms of algorithms is something that financial services organisations need to be interested in. So what are some of the things that we might do? I mentioned before, and I believe very strongly, that the CEO and the board need to get much more knowledge and visibility in terms of what's going on in their organisation and what's going on with the technology that they're implementing, and thinking about some of those ethical issues in terms of the services that they're providing. So this is a very important consideration. So as I mentioned earlier, organisations can think about encoding ethical principles in the design of their technology, but this means that those digital ethical principles need to be developed and adopted. So there is a role both at a policy and government level and also at an ecosystem level to think about what are those ethical principles that you're asking people to encode in the development of new fintech innovations. The second one is helping developers understand the ethical outcomes of what they're doing. Because as I said to you before, generally engineers and developers are not trained in ethics. And so they're thinking about how to make technology work. They're not necessarily thinking about what is the impact of that technology on a population. So helping them be more prepared to be able to understand the ethical outcomes of their technological innovation is important, and maybe training them in ethics. As I understand it, there is no professional association for software developers. Perhaps it's time there was, and perhaps ethics is one of the things that the organisation needs to be embracing. There's no professional ethics standards for software developers. These could be a solution to how we address some of those ethical problems. And probably because consumers are not aware, there's not a great deal of community demand for ethical approaches. And so consumer education and an understanding of ethics and what's reasonable for them to ask for is something that might strengthen the pressure on financial service organisations to be able to think and implement and act in a more ethical way. So how do you, as a financial services professional or as a financial services organisation, how can you respond to this? So the first thing is to think about transforming business ethics in this new hyper-connected, hyper-automated digital world. So that means rethink your approach to ethics and reframe it in a digital way, because your organisation is going to be impacted by these digital trends, by this growth in fintech, and you need to move your ethical approaches along with that. The second approach, which is getting more common and more popular, is around digital rights management, and there's a whole literature on digital rights management that you can read to understand how to create better and ethically safe online spaces. Digital literacy for all of us, for leaders in the new world, is essential to prevent creating new exclusions based on technological literacy. Leaders in the future have to be literate in digital and technology in order to be able to be an effective leader in the new world. And possibly developing a code of conduct for digital business ethics. So techno-ethics, framing of principles and methods to guide technology implementation and use. This could be developed for corporations, communities, governments, and those who design the systems. So there's work to be done. There's work to be done almost at every level of this very rapid development of fintech in relation to risks, opportunities, and regulation. So as we're coming towards the end of the presentation, and I will be absolutely welcoming your comments and questions, just going back to the global trends in fintech. In summary, the first point is that we have these major trends that are taking place in digitalization, platformization, dematerialization, and an interest in measuring the social impact of the work that we do and the things that we consume and the way that we implement. And these things are affecting all industries, not just banking and finance. In banking and finance, you see the growth of fintechs absolutely exponential, with the use of a number of new technologies, which are both changing the way people consume finance, changing the way companies deliver finance, and are going to create new and change competition for banks. And one of the things to think about as a financial services organisation for the future is what kind of organization might I be in the future? Because I don't believe that you're going to be a bank. You're going to be a platform provider that provides financial and other services. You're going to be very focused on maintaining what you now call your customers, but what will become your network, and thinking about how to use all of those technologies to keep your customers and your network loyal and using your products and services. And then thinking about the implications of things like embedded banking, where you have almost every type of e-commerce organization offering financial services. So what impact is that going to have on your business? Or are you reaching out looking for collaborations and partnerships, which of course many financial services organizations are collaborating with fintechs and also purchasing fintechs, buying the technology so they can use it in their own implementation. So these are critical risks and challenges that are going on for financial services organizations all around the world. And one of the challenges, both for you, for your leadership and for your teams, is how do you get that kind of knowledge and information? How do you get it available to you so that you can be aware of what these future trends are, and you can think about how to reshape your organization to be fit for a digital future and to be fit for your customers of the future who are not your customers of the past. All of this exciting movement, of course, creates new challenges for compliance and regulation in fintech. And as we've discussed, there are no global standards as yet. Regulators all around the world are working on trying to figure out how to do it. And if you remember the point that I made about the same activity, regulation is not going to be able to apply to all of these new fintechs in the ways of the past. Regulators have to understand what the technology does and what activities is it undertaking to think about how and whether to regulate. So is it a commodity? Is it a security, for example? Regulatory cooperation all around the world is needed. And regulators need to learn together, and regulators need to learn from industry, because industry are the ones who actually know what's going on. And all organizations need to find people who can help them think through what their fintech strategies need to be, what policies and regulatory issues they need to be dealing with, what are some of the risks and what are some of the ethical issues with the way that they're moving forward. And then finally, as I said, with ethical risks and considerations of using fintech in financial services, we are absolutely amplifying and exponentially increasing the ethical risk through digital means, because wrong decisions can impact on hundreds and thousands and even millions of people. So getting the ethics in the technology right is going to be important for you as a financial services organization, but also important as leaders in the new digital age, to be ethical leaders who are thinking about harnessing these technologies to their maximum impact and for the benefit of society, and mitigating their negative risks. So for reflection, I open questions. What Kingdom of Saudi Arabia? Certainty, and what international regulation should be adopted, and what international regulatory is going to be needed to allow Saudi to develop and compliance in an appropriate, socially and culturally appropriate way, but also bearing in mind that this is a 24-hour, 7-day-a-week market that moves across borders. So thank you very much for listening. I apologise most sincerely for some of the technical difficulties. I'm very happy, as I've said, to the Financial Training Institute to make my slides available to all of you. And I'll now hand it back over for any questions coming from the audience.
Thank you, Mr. Jane, and we really appreciate your time. And we are so sorry about the technical issue that we faced earlier. And I would like to ask you some questions that came from from the participants. The first question is, how is fintech changing financial services?
It's changing financial services so fast. I remember back in 2017, and I was at a conference and they were showing all of the financial services that already the big techs are entering into providing, like Apple, Google, Facebook, and Amazon. And what I saw then, it was one of these slides where they're comparing, all of the main services that financial services organizations offer, and then what these big techs are moving into. And I had one of those aha moments, which is financial services are changed forever because these big organizations that have so much power and control are moving in and actively competing with traditional financial service providers. And so in addition to that, so that's the big techs. In addition to that, we have many, many small fintechs who are developing these great ideas and implementing them at a speed faster than we can imagine. So the whole financial services industry is undergoing very rapid transformation, very rapid deployment of digital as a way of transacting. And as I've mentioned to you before, and I mention it again because it's so important, your customers of the future are Gen Z and Gen Alpha, and they're going to demand changes to financial services as well. So it's been completely transformed, and we must be alert to that.
Perfect. Okay. The second question is, why do consumer preferences matter to the future of the financial services?
It's such a change, isn't it? Because when I grew up, your bank had all the control. You would have to go to the bank. You would have to provide them with all of these things to get, whatever service you wanted. It was never easy for you, and you would have to go many times to do 10 different things that you were trying to do. But what's changed now, particularly with the advent of the platforms, is it's moving from a product to consumer focus to a platform and a service focus where the consumers actually have a say in what they want to receive from you as a financial services organization and how they want to receive it. And because there's so much competition now in the financial services market that did not exist before, consumers can choose to move. It used to be so hard to move from one bank to another. Now you can move really quickly with open banking. And so consumers will choose with their feet. And so therefore, what services consumers want, how they want to receive them, and how they want to interact with you is absolutely vital to the survival of a financial services organization.
Brilliant. Okay, the third question is, what are the key risks of AI and digital assets?
Look, there are a huge number of risks of AI and digital assets. If you're thinking, I gave you a breakdown earlier during my talk of thinking about, at the application level, at the base infrastructure level, and at the social level. If you're thinking about the base infrastructure level, then you have to think about things like data security, privacy, how data is managed, where it's stored, and protecting the integrity of the data that you have access to. At the application level, then you're thinking about consumer protection, money laundering, terrorist financing, crime, taxation, evasion, and so forth. So these are all risks. And as I mentioned too, the fact that we now have 24-hour-a-day, 7-day-a-week financial markets, which means the bell doesn't ring. and everyone goes home to bed. The bell never rings on these new technological driven market. To do with financial services brings all sorts of risks. And there's a lot of work for governments, policymakers and organisations to do around those risks. And of course, I can't finish risks without talking about cybersecurity. Cybersecurity will be at the root of what everyone has to do continuously for the future. That's absolutely critical.
That's great. Okay, 2 questions remaining. Is there any global regulatory guidance for fintech?
So not in the sense that there's any global set of regulations and guidance that have been adopted by any global grouping of countries. What you do have is access to some of the regional work, and I mentioned to you the EU MiCA work, for example, and some of the ways countries are dealing with AI policies and regulations. We do have the 3 global regulators, if you like, around terrorist financing, anti-money laundering, securities and so forth, and they put out guidance, but these have not become regulations as yet. And, you know, please do go and have a look at the work they're doing, because they work very hard to try and get as many countries as possible involved in developing the regulatory guidance that they have. And I did mention to you the work that's due to come out towards the end of the year or early next year around Commonwealth countries, around a common framework for digital asset regulation. But the short story is no. And it takes work. You need to have researchers, or you need to have knowledgeable people who are keeping up to date with all of the movement of thinking and regulations and decisions that are being made on a country-by-country basis to inform you as a sovereign nation what's going to be the best approach that you need to take to protect your citizenry, and also give them the advantage of AI and digital assets and the technological innovations that will improve their lives.
Great. The last question is, why do digital ethics matter?
Well, as I said, you might remember that quote that I gave, and people, please have a look at it when you see my slides. Technology gives us choices. We have more choices than we've ever had before in the history of the world. But only ethics is going to tell us which of those choices are sound, because ethics takes into consideration the benefit for society as a whole. And so thinking about how these tools and technological innovations may negatively impact on some aspects of our society or sectors of our population, as well as how it gives them benefits, is critically important. And the reason that it's more important than ever, ethics has always been important in financial institutions, but the reasons that it's more important than ever is because this is all automated. And so algorithms make decisions that impact many people. Bias in the data sets that the algorithms are being trained on can actually impact again on hundreds, thousands, and even millions of people. So understanding that, understanding what these technologies do, how they're built up, on what assumptions, on what data the algorithms have been trained, is really vitally important for leaders in financial service institutions. But more than anything, techno literacy, understanding what are these technologies, what do they do, how do they work, how do they impact on the future of your organization, and how can you protect against these harms or dangers, is really critically important for every leader everywhere in the world.
Perfect. Thank you so much, Dr. Jane. And for everybody who is interested more about this subject, we would like from you to visit our website and check more about the workshop and webinars that we have. Thank you so much, Dr. Jamie, and I hope that everybody is enjoying this journey, and I hope that we reached your expectations. Thank you so much. Have a nice day.
Thank you. It's been an honor. Thank you very much, everyone, and goodbye.